With the 2024 presidential election fast approaching, a topic that is on a lot of people's minds are concerns over the outcome of the upcoming election and its impact on the economy, on markets, and world events. I have joining me today Michael Humbert, investment strategist at Dimensional Fund Advisors, to discuss this topic. Welcome, Michael. I'm glad to have you.
Thanks for having me, Jesse. It's great to be here today.
And we've seen over past election cycles that as we get closer to the election, rhetoric tends to rise amongst the media. And one of the effects that this can have is that people tend to overreact when it comes to their investment portfolio. What advice would you give for investors in terms of avoiding the temptation to get out of the market?
Yeah, I think you hit on a couple really interesting developments with that question. First and foremost, there's certainly a lot of information presented to investors every single day. And during an election cycle, that tends to dominate the headlines. And as you noted, even as we get closer and closer, it dominates more and more of that news cycle. It's incredibly difficult to tune out that kind of noise because events like presidential elections, congressional elections, of course, they matter to us. And we think that there has to be something we can do about that. But the research that Dimensional has done through time has shown that presidential elections, investors' expectations for it, it's exactly the kind of thing that is incorporated into market prices. And so, what can investors do with those expectations? What can they do? Their best course of action is to really kind of tune out the noise around presidential elections, trust that markets are incorporating that information. And maintain focus on their longer term goals rather than some of that short term information around presidential elections.
So if we look at history about past elections, what has the stock market told us? Or
Yeah, if we looking at past elections, the returns leading up to an election, whether it be presidential, congressional, mayoral, whatever it might be, returns following those elections through time, what we see is that investors, they generally invest with a positive expected return. They put their dollars to work, expecting the return to be positive, and that's what we see regardless of who's in control of the seat of power over the long term. We extend our horizon through almost the 100 years of returns that we have here in the US. We see that the return experience has generally been positive, regardless of who's in the seat of power at the time, which is in line with our economic intuition and an understanding of, why investors choose to do so, why investors choose to invest.
so on a more specific note, we've worked with Dimensional and broken down market results over longer periods and different political scenarios. And looking back to 1928, isn't it true that an overwhelming majority of presidential administrations, whether Democratic or Republican, have left office with stocks actually moving higher than when they took power?
That's right, Jesse. So over that 100 years that I alluded to, we've had a few presidents over that period as well, and some have been Republican, some have been Democratic. When they enter the White House and when they leave, what we generally observe is that markets went up over that 4-year period. There are a few examples, right, around the Great Depression, the end of George W. Bush's presidential tenure there with the great financial crisis at the tail end of it. But by and large, we see for the rest of the examples there that the return experience over the 4 years, over just 4 years, has been positive, regardless of the who's actually in the White House.
Yeah, and you've also researched the stock market results over that extended period when the U.S. had a divided government. What do you mean when you say divided government?
Right. So the intuition there being, oh, can Congress get more done? What we mean by divided is Congress, in control and with one seat? Are the Democrats in power? Are the Republicans in power universally? And are they able to, as such, kind of effectuate their plans with limited, resistance from the other side there? And what we observe is that in those periods when Republicans were in power, or Democrats were in power, or maybe it was even mixed, same trend applies. There's no pattern there showing that one party outperforms the other on a consistent basis, and generally we see the returns go up and to the right over that longer trend, which many investors should find solace in, understanding that over that short-term volatility gets washed out over the longer term, and their return experience can be has been much more positive.
So we see similar results. What does this suggest to a long-term investor?
For a long-term investor, I think the takeaway would be stay in your seat, trust the allocation. Don't let that short-term noise, headlines deviate from your long-term goals. Understanding that elections are just one consideration, one factor that are incorporated in market prices. At Dimensional, we believe market prices are effective tools used to aggregate investors' expectations for the future. And so, whatever the expectation for the next presidential election or congressional election is, it's considered within market prices alongside everything else that investors consider as well. So, don't pay too much attention to one data point. Rather, keep a more complete view over the longer term goals about why we set those allocations. Those mix of stocks and bonds help us achieve those long term goals without being derailed around some short term noise, headlines, whatever it may be.
Now, what if it's a unified party? I know we've had different periods throughout the 98 years where the party's been unified, meaning under control of either Democratic or Republican Party. When we look at the returns over those periods, what do we notice, or what have you noticed?
This other side of the same coin, though, are you still taking that subset of data and you're not seeing a statistically reliable information between who controls the government and ultimately stock market returns, which again makes sense with our understanding about what prices are doing. They care about what's happening in the government. Of course, the choices that governments make are meaningful and important to investors, but it's the kind of information that investors are pricing in on expectation in aggregate alongside other information as well. Demographic trends, trade, inflation, GDP, their own personal needs, and on the individual level, their own personal needs and goals, where they are in their lives. All of this information is in aggregate priced into markets. And this gives us a very powerful tool for positioning our portfolios, given all the information that's contained within them. But trying to draw one signal like presidential elections out there from that, and we don't see a statistical reliable way to capitalize on that trend in a way that investors can use in their allocations.
So, in summary, while past results can't guarantee future results, what does such a comprehensive review of elections and view blue chip stock performance show us?
I think for investors, a great way to think about elections is, of course, they are important. Of course, the outcomes of elections matter. They matter to investors and they matter to us as individuals. They matter to our civic duty. And so a takeaway can be, of course, go out, vote, participate in the elections, participate in the electoral process, but vote with your ballot. Don't vote with your dollars. Take a longer term view, maintaining that focus on why we delay consumption today, why we invest today, so that we have capital available to us tomorrow to help us meet our long term goals. Any choices that we make on allocation decisions around today, based on some of the headlines or our interpretation of what we think will happen, ultimately deviates us away from the allocation that we set with those long-term goals in mind. If we take that as given for the optimal allocation, deviating away from it represents costs. We want to be cognizant of those costs and maintain a longer-term focus rather than try and time markets, which is a bit of a different topic, Jesse, but we know that timing markets doesn't work either.
Well, such wisdom in your words. I want to thank you, Michael, for joining us today. I really appreciate your time.
Thank you for having me, Jesse.